Welcome to this Ivey Impact live session, Market Mayhem, Investing Amid Chaos. I'm Julian Birkinshaw, Dean of the Ivey Business School. I'm excited to be your host and moderator today. America's new approach to trade has introduced a level of unpredictability that is reshaping the global investment climate. The question on everyone's mind, how can investors find stability amid this turbulence? We're living in an era where markets are no longer driven by fundamentals alone. Instead, they're subjected to abrupt policy changes, geopolitical uncertainty, and volatility that can shift overnight. Investors are no longer simply evaluating risks, they're navigating an environment where uncertainty itself has become a defining feature. In today's discussion, we'll explore the forces unsettling global markets, assess the real risks facing investors, and perhaps most importantly, outline some strategies to chart a course through this storm. We have an outstanding panel of experts with us today who will bring clarity to the chaos. I'm pleased to be joined by Aaron Bennett, Chief Investment Officer from the University Pension Plan, Dagmara Fijalkowski, Head of Global Fixed Income and Currencies, RBC Global Asset Management, and a valued supporter of Ivey's Women in Asset Management program, and Steve Foerster, Finance Professor and my colleague from Ivey. We've received a number of questions in advance that we will attempt to get to. I'll also encourage you to drop questions for our panel into the Q&A function as well. The session's being recorded and will be made available on the Ivey Impact site. With that, let's dig in. Steve, quick cold call for you. You've been given the task of providing a little bit of context and setting the stage for us. So over to you.
Thanks, Julian. I've got 3 slides I wanted to share. This first slide shows how expensive the markets are, the U.S. stock market. And this is a well-known metric looking at price relative to earnings. It's the Shiller CAPE index. And what this chart shows us, and this goes back to the 1800s, we're currently in a time where stocks are expensive. The price that they're selling for is very high relative to the last 10 years of average earnings. Except for a brief period in 2021, the last 2 times that stocks were this expensive was just before the bursting of the dot-com bubble back in 2000, and also all the way back to 1929, just before the major stock market crash and the subsequent depression. So we have to take that into account right now. It doesn't mean necessarily that stocks are going to go down. You can see from the chart that stocks have been expensive for a while, but it's something that investors should keep in mind in terms of setting expectations going forward, let's say for the next 10 years, in terms of what to expect. The second chart focuses on stock returns during election cycles, presidential election cycles. And the data go back a century. And the big takeaway from this chart is that across this 4-year presidential cycle, stock returns tend to be lower in the first 2 years compared with the 3rd and 4th years. The narrative here is often that new administrations take some bold actions that perhaps might not be friendly to the stock market, but later in the administration, perhaps around the time near to re-election, then that's where some of the policies are more favorable to the stock market. So again, it's trying to set expectations in terms of lower expected returns on average during the first couple of years compared to the last couple of years of a 4-year cycle. Finally, this last chart shows us real time where stock returns have been relative to the November election. The blue line shows an average over the last century of average stock returns during the first year from the start of an election in November. So we see that on average, during the first year of an administration, stocks have risen by around 11%. The upper red line shows what the stock performance was during the Trump 1.0 administration, and it was a very strong market with first year capital gains of around 28%. And finally, we have the current Trump 2.0. And we can see that while initially it looked like the Trump 2.0 stock return performance was tracking the first 30 days or so of trading as compared with the Trump 1.0, we see a major change. And basically, the stock market has been flat since the November election with a lot of volatility. In fact, the volatility in Trump 2.0 has been twice as much as Trump 1.0, which is very consistent with what we've seen in the news.
Got it. Thanks, Steve. So a lot of us, certainly myself, have made the observation that Donald Trump cares about the stock market. He certainly did last time round, but the current evidence is that the market is not going in the direction he might have liked to see it. So a couple of reflections on that, Dagmara, perhaps first. What do you see in Steve's slides that either gives cause for alarm or cause for reflection?
Thank you, Steve. This is definitely a good setup for a discussion. The couple of observations that I have here is that, first of all, the measure of how expensive the market is treating S&P 500 as the only market in town. And of course, it's not even for the US, right? If we looked at the same measure X, the Magnificent Seven stocks, or equally weighted even S&P 500, you would come up with a different conclusion. And of course, on top of that, you have the rest of the world that has been in a long period of underperforming S&P 500. So this is a very valid yardstick, of course, because US covers majority of the global stock markets, even including emerging markets. But even within US, there are richer and poorer cousins, and S&P 493 would show a different picture. The second observation that I have is that the same Case-Shiller chart is perhaps giving us some, as you mentioned, Steve, toned down expectations for future returns. I have seen a very nice overlay on that chart of subsequent realized 12-month 10-year returns in stock market. And if you advance the Case-Shiller chart by 10 years, that leads to single-digit returns over the next decade on stocks. So instead of our investors being used to double-digit 20% returns from S&P 500, we're talking here, tone down your expectations. Single-digit returns over the next decade is probably what we'll have to deal with. And that means lower equity risk premium.
Right.
And adjusting these expectations is very important.
So I think, if I can bring in Aaron here, please, because I think, well, most of us would agree that the very impressive returns we've been getting from our portfolios over the last decade have been driven, as you say, a large part by the US, a large part by the US tech stocks. Aaron, do you think, are we at a point, very simple question, is it overvalued? Should we be adjusting our expectations of returns in the next few years? Any other reflections?
Yeah, I think you certainly should be thinking about, on average, lower returns out of the equity markets, particularly the U.S. I think fundamentally you're seeing businesses represented in the indices. They still have positive expectations and positive fundamentals here, but those expectations in terms of what they could be like in the future have really run ahead of where the fundamental performance of those companies are currently at. And now you overlay this with an administration that is pushing for what appears to be a significant rebalancing of the world order and taking a more transactional approach to diplomacy and trade. That creates a lot of uncertainty and diminishes people's willingness willingness to look through uncertainty and to continue to invest at these high multiples.
Yeah. Now, as you say, I mean, everyone knows business hates uncertainty. Consumers hate uncertainty. We all hold back on expenditure, and the risk, of course, of that. We'll get into this. You know, recession is non-trivial. Steve, just to Dagmara's question, then. I mean, yeah, we focus on the U.S. stock market a lot, but you know, the vast majority of this audience is here in Canada. Should we continue to use the U.S. as our barometer of, you know, global and indeed Canadian sort of financial health?
Certainly, it's one part of the equation, and if you look historically, the U.S. and Canadian markets have been the most highly correlated markets in terms of returns among all markets. So it's certainly a consideration, but point well taken. There could be perhaps some kind of reordering just as investors look at what proportion of their portfolio should the U.S. take up, where right now we're almost in a situation that we saw Japan in the late 1980s, where Japan globally had the biggest market share, and certainly decades later pared back. So we could be at a bit of a reflection point with the U.S. Now as well.
Got it. And in terms of other markets, I mean, and I'm no expert here, but you know, what is the overall state of, you know, Asian equities? I mean, Aaron, perhaps you can have a go at that. I mean, I didn't prep you on this question, so perhaps you don't even know, but I'm guessing you look at the returns on these various different markets around the world.
Yeah, and I think one point that I would make is you're seeing a greater dispersion, a greater range of outcomes across the world, where as opposed to the last 10 or 15 years, we saw a real synchronization of cycles, both on the central bank and the equity side of things. You're seeing more of a dispersion here. You know, you're seeing Asian markets, even within Asia, react very differently. And you've seen China move in one way and Japan move in another way. And now you're seeing them reverse to some extent as well, and I think you're going to see a lot more of that. I think you're going to see a lot more of variation and a lack of correlation between the different markets in Asia, and I think you're starting to see a lot more interest in Europe more recently because of some of the changes going on there, particularly in Germany.
Right. Yeah. I mean, I'm from Europe, as most people will know, and European equities markets have been terrible for the last few years. So it's quite possible a bit of a rebalancing is needed there. Dagmara, let me go to you, because, I mean, we're talking about equities, but obviously most people have a mixture of equities and bonds and cash and goodness knows what else in their portfolios. You've got a real expertise, obviously, on fixed income. I mean, if we're if we're predicting that we're going to get lower returns from equities in the years ahead, should we be piling into corporate bonds, into treasuries? I mean, what's going on there? Because obviously we've got an economic situation where, you know, interest rates are starting to come down. We're starting to look at possible recession. How should we anticipate the bond markets moving?
Well, I don't know about piling in, but certainly having a second look is a worthwhile point here. I think, you know, before COVID, we had a decade of extraordinarily low interest rates, and equity risk premia had been particularly attractive because expected returns on stock market had been attractive. Now we have just discovered or covered the point about the lower expectations for future returns on equities. So when you compare that to expected future returns on even government bonds, that differential, the equity risk premium, is much lower now, which suggests to you that you should probably have allocation to bonds more significant than you had in the previous period, right? When interest rates were so low that they weren't even covering risk of inflation. Generally, if you think about bonds in your portfolio, you think why you hold bonds. You hold them for income, mostly. You hold them for insurance, potentially stability and liquidity. Well, income had been particularly low, but now it's more fair valued. Real rates are about 2%, which is close to as high as they had been in the past 25 years. The inflation expectations are maybe not coming down as quickly as Fed would like, but they are coming down, and I believe in Fed intention to get us to the 2%. And term premia became positive. So from the valuation perspective, its bonds are trading much closer to fair value.
Got it.
Looking from income perspective, but on top of that, you have this insurance quality. And I know that in 2022, a lot of investors were burned because insurance quality in bonds didn't work. Bonds and equities went down that year. But I think 2022 was particularly unique year. That was a year when inflation had been high and rising, surprising the market. And if you do historic analysis, you see that when inflation is low and stable, as we expect it to be over the next few years, correlation between bonds and equities goes back to negative.
Got it.
It's only during periods of inflation being above 3% and rising when that correlation is going positive, because yields are being driven by inflation expectations, not growth, and rising inflation expectations are negative for both bonds and stocks.
Wow. Okay, so there's a lot to unpack there, but I want to add an additional point, which we're all aware, I think, that the US has a huge national debt of $35 trillion or thereabouts. I read that their annual deficit is as great as their entire defense budget. So we think of US treasuries as this sort of safe place to put our money, but perhaps the academic view, first of all, Steve, I mean, should we be worried about things like that? Because we've no idea how the Trump government's going to behave, but it's a safe bet that they're going to be spending more money before they save money. What's the impact of that on, future growth and future sort of prospects for the treasuries?
Julian, that's an excellent question. The U.S. has been blessed for decades to have its currency as really a reserve currency around the world. And so countries just naturally pile into US dollars. And the result of that is that allows the US government to borrow quite a lot at low rates. I think there's going to be a turning point. When that will occur is hard to predict. But there will be a reluctance at some point for other countries to pile into US dollars, which is going to mean that borrowing in the US is going to be more expensive, which then can have a downward impact in terms of the stock market and economic activity as well. I wish I could tell you when that inflection point would be reached, but it's something to keep in mind.
Indeed. Now, as we know, I mean, seeing that something's going to turn down at some point in the future is easy. Knowing when is the challenge. Aaron, your thoughts on all this? Because you're in your role, you're looking across all the different asset classes.
Yeah, and I think it's a great question, and one that we're thinking a lot about, and we've been thinking a lot about for a while. I agree with what Steve said around. There does seem to be some room now for alternatives to emerge. However, I wouldn't really underestimate how well the current system has worked for the global economy and what that means in terms of the inertia against change. So I would expect, a continuing slow weakening of that extraordinary privilege that the U.S. has had. But I wouldn't expect it to come to an abrupt end. I mean, the alternatives are emerging, but none really have that combination of global acceptance, liquidity, stability, and large open financial markets that you expect out of a reserve currency. Now, there is the new element of economic and political stability, which is usually related to reserve currencies, that is perhaps being called into question. Although I was reminded as I was traveling in Asia recently that, we perhaps have a very narrow view of what that looks like. And relative to the rest of the world, even under current circumstances, the US still has a level of economic and political stability that many countries would still look upon with great envy.
Yeah. No, it's true. I mean, and for all of the turmoil we see, as you say, if you look at the fundamentals and the size of the US economy and the companies that are based there, as you say, it's hard to imagine it all going wrong. I'm going to move to the question of risk, and I'm going to take the academic view before I bring Dagmara in. Steve, I mean, give us a definition of risk in terms of how we understand it and whether the crazy policy changes we see happening on a daily basis actually change our view of risk.
Sure, Julian, if we just step back in a word, we can think of risk as volatility. We can think of it as uncertainty. Right. But just to step back and tie it into stock prices, and apologies to anyone who's joining the call as former students. Actually, Aaron is one of them as well. I like to focus on two factors that are really value drivers for any stock, and that's growth and risk. Our expectations that cash flows are going to increase. Where risk comes into play, if we can think of at a very fundamental level, what should a stock be worth? It should be worth the present value of expected cash flows discounted at some kind of appropriate discount rate. That's where risk comes into play. That discount rate, the riskier those anticipated cash flows are, then the higher the discount rate, and therefore the lower the value. So that's really the key connection. The more uncertainty that's out there, and that's why some of the Trump proclamations related to tariffs that seem to change daily, if not hourly or minute by minute, that creates all kinds of uncertainty. That would then increase in aggregate the discount rate that would be applied to individual stocks, to the market as a whole, and become a negative drag. What do investors care about? They care about two things. They care about expected returns on their investments, and they care about the volatility of those expected returns. And they don't like uncertainty. They don't like chaos.
Yeah, and of course we've kind of been here before. I mean, this isn't the first time we sit down and think, oh my gosh, what's happening in the business world? And COVID was a particular instance, and the financial crisis and the global financial crisis. Any particular learnings from then, Steve? And then I'll go back to Dagmara and Aaron.
Sure. I think oftentimes we don't know when shocks are coming. There's certainly the global financial crisis, 2007, 2009, that was certainly a shock, and certainly COVID, totally unpredictable, and so that was a shock. I think in the current situation, it's almost like waiting for that shoe to drop, and perhaps that shock in the form of Trump might be more likely, but we just don't know what and when and the extent to it.
Got it. Dagmara, has your view on risk changed at all in the light of the last 8 weeks of Trump turbulence?
Well, first of all, I would say that it's not just Trump that has contributed to turbulence in the markets, although it's easy to forget that because he continues to supply us with hourly headlines. But the other two sources of turbulence had been, of course, announcement about DeepSeek innovation from China, which had led the market to reevaluating the CapEx expectations for North American markets, and that led to a bit of a pause also in enthusiasm for big tech. And finally, the third one, which is the February 28th meeting in the Oval Office between Presidents Trump and Zelensky, which led to what I call a cold shower or kick in the pants of Europe to reevaluate the need for fiscal spending on defense infrastructure and potentially leading to deeper integration in Europe. These can, the tariff policy, the AI acceleration at cheaper prices, and the fiscal unshackling of Europe, these are ingredients for a tectonic shift in the markets, leading to repricing of relative repricing of European stocks, for example, versus US stocks. And the risk, I think, from my perspective, is at the moment in being undiversified investor in stock markets. That's where the biggest risk lies, especially if that happens on a currency unhedged basis. I believe that at the moment exposure to for foreign investors into US equities on an unhedged basis, the tailwind that carried that investment through the past decade is turning rapidly into headwind if these policies are implemented on the currency side and potentially on a relative growth basis between European equities and US equities.
Got it. Aaron, anything
So
you want to
overall,
comment? Please. Aaron,
sorry,
any
go ahead.
comments on that? I want to move on to the next topic in a second. But...
Yeah, I would just make two really quick points on this. Is very often in my world, in the pension business, the risk models that we use are based on historic performance, which is an important lens, but it's not the only one. And particularly, we think a lot about extreme tail risk that Professor Foerster was talking about, and I think those are changing. And the second point is on geopolitics. Is typically investors think of those as idiosyncratic or something that you can avoid by just saying, okay, we're not going to invest in that country, or we're not going to invest in that region, or we'll avoid that investing there. But one of the things that is different this time, and I think as Dagmara highlighted, is when it comes to the US and the scale of change that we're seeing, that starts to verge on the to the point of being systemic, which is something that's very hard to hedge and something that's very hard to avoid, even as a global diversified investor.
Got it. And in fact, I've got a follow-up question exactly on that topic. I'm just looking at a couple of the questions that have come in on the screen here. Somebody asked what currency can possibly replace the US dollar. I don't think you even need to reply to that because there's no obvious solution. The euro, the yuan, they've got their own challenges. But one of the questions specifically says, look, we've been talking about valuations in public markets, but of course, there's many other types of assets out there. And I guess I'm going to go back to you, Aaron, on this, because you obviously have to take care of my pension amongst those others, the university pension plan. Thank you for doing that. And you are looking across private markets, you're looking across real estate, you're looking across private equity, you're looking across some of these other non-traditional investment areas. How should we be thinking about some of those other options, other than the ones which are visible publicly where there's an obvious tradable value?
Yeah. And I think it's an area where there's a lot of potential there. Diversification should really be an important focus for any long-term investor. And you want to ensure that you don't tilt into what I might call diversification, where you have too much diversification and you just lose all the benefit of that. You also need to think about what are you trying to diversify against? And this is where you get into thinking about new asset classes or some of the less standard ones that you see in personal portfolios, like gold, like commodities, or perhaps even some cryptocurrencies. I think a lot of these have started to come up because one of the toughest things to diversify your portfolio against is inflation.
Right.
And we've seen that inflation is something that can come back. It's something that I expect will be in an environment where it might be a little bit higher. It'll certainly be more volatile than we've had over the last 10 or 20 years. And so finding those asset classes that can provide you that inflation hedge are really, really difficult. And I think that's why you start to see people more interested in some of these areas like cryptocurrency and gold, We've also found that there are some asset classes that you can tap into via the private markets, things like infrastructure and certain forms of real estate that have a good correlation to inflation and can provide you some of that long-term hedging as well. So an important thing to explore in any portfolio is that concept of diversification and where you're going to get that from.
Got it. And I think we all understand gold as this safe haven. Gold prices, I believe, are up. But let's spend a minute on crypto, because I'm a skeptic, and I suspect most of you are as well. But can one of you make the argument why investing in Bitcoin might actually be a good thing? Because the starting point is that this is just a bunch of bits and bytes. It has no, unlike gold, it has no intrinsic value. And yet, I think it's $88,000 is the current price of Bitcoin. There's a lot of people who think there is something there. What is the argument for doing that? Even if you don't believe the argument, can one of you make the case for why Bitcoin might have some value? Steve, go for it.
Sure, I can do that. And this is, again, coming from a skeptic's perspective as well.
Right.
I think we can make the same argument as why gold. If enough people believe in something, then it can become real. Historically, why besides nice gold charms, why gold? And it's hard to come up with that logic, except that we've had centuries of having this gold that has a limited amount of supply and so on. And so in a sense, Bitcoin in particular has that notion of scarcity, and it has, for better or for worse, it's becoming more mainstream. Right. That being said, the counter argument is and this applies to gold as well. It's not something like stocks that have this backing of the ability to generate cash flows and dividends.
Yeah. No, exactly.
And
of course, please, Aaron.
Yeah, I mean, it's an interesting point. I agree with everything Professor Foerster said. And to be clear, we don't have a target allocation to crypto, but the one thing that keeps me thinking about it is I don't really know what it is, if it's a commodity, a currency, a venture capital investment, but it as an asset class has survived many things that would have killed off most asset classes. So it feels like something that you got to keep an eye on. And I think that's something that still keeps it in people's range of interest.
Yeah. And of course, the risk opportunity is that the Trump administration sort of legitimizes it, as we know he's a little bit of a fan of crypto. And to the extent that then gets some sort of backing from the administration, from regulation, then it does become potentially legitimate. I mean, so potentially even more valuable at the moment, because it sort of sits on the outside of the legitimate world of currency. We do our best to ignore it, but we can't. Okay, Dagmara, you may not have a view on crypto, it's up to you, but tell us about some of the other alternative asset classes that you look at in your role.
Well, actually, in my role, I only look at public markets because our investors are mostly investors in mutual funds and institutional investors that are looking in public market investments. Okay. As a result, I don't have to have a professional opinion in crypto, and I'm quite grateful for that. In terms of our investors, liquidity matters a lot, and transparency about what's driving value matters a lot. And I'm not able to put valuation on crypto, unfortunately.
Yeah. Well, indeed, and like even more than some of these tech stocks, this is a meme stock. In other words, it goes up and down in value according to the latest crazy utterance from certain public figures. I want to change.
In my mind, it's a much more volatile cousin of S&P 500. It trades like a drunken version of S&P 500.
Okay. Excellent. I'm going to change tack here. So the Canadian pension model, the so-called Maple 8. I mean, there's more than that, of course, but a couple of the major public pension funds in Canada are kind of world famous. And I moved from the UK to Canada just last summer. And the UK Chancellor, a lady called Rachel Reeves, just before I left, I picked up this quote. She said, "I want British pension schemes to learn lessons from the Canadian model and fire up the UK economy, which will deliver better returns for savers and unlock billions of pounds of investment." And that sparked a whole range of conversations about what is this amazing Canadian model of investment, because a lot of the UK people have no concept of what exactly it is. Now, Aaron, you work in that sector. I mean, you're not one of those biggest 8, but you're a pretty big manager of assets, and you use many of those same policies, I believe. So just for the benefit of the audience that isn't quite so attuned to it, just tell us what are the characteristics of this Canadian pension model that the UK is looking at so enviously?
Yeah, and thank you for bringing it up. It's one of those things where I think as Canadians we're far too modest about it.
Right.
We really do have one of the best and most sustainable pension industries out there in terms of really making sure that people have the confidence that they can retire with these defined benefit pensions. The Canadian model is really based on independent arm's length governance, professional investment management that allows you to do diversification and internalization to ultimately provide all those pension members the benefits of scale. When I think about all those elements, the governance is really the secret sauce relative to what you see in a lot of other countries. And just by way of example, I can tell you I find a tremendous value for our members and my investment team in the structure where we have an investment committee of trustees from the board. They're all nominated by our members, and those trustees have decades of experience in the financial and pension sector, as well as some serious academic expertise. Having an investment committee like that to oversee what my team is doing is incredibly powerful and useful. And that governance enables an organization to really take that long-term view and to think about innovative things like going into areas of diversification like private markets and areas of private credit, taking some of that illiquidity premium and benefiting from those things and some opportunities there, and internalizing certain aspects of the management of the fund to really take out that middle person, that intermediary, and that decreases costs and increases control. And all of that flows back to members because we're effectively a nonprofit. The benefits flow back to the members and flow into their pensions and drive sustainability for the long term. So I think it's an incredibly powerful model. It's a lot easier to say that you want to execute the Canadian pension model than to do it.
Yeah. And what have the returns been over the last decade or so compared to other major asset classes? I mean, there's no reason why you'd have the number on the top of your head, but you must have a pretty good sense of it.
Yeah, I would say I think the returns over the last several decades have been quite good. I think you'd see most of the Maple 8 are into the high single digits, low double digits. Though in pension land, we think a little bit differently about those things. It's less about what the performance is in any one year, and it's more about the long-term performance and the volatility of that return. Because ultimately, we're not here to necessarily beat the market every time. We're here to fund the pensions. And so we create the portfolios that give you the greatest confidence, that are aligned with the risk appetite of our members. And so we think about funding ratios, the ratio of assets to liabilities within the pension. This is a key indication of whether or not the pension is fully funded or not. And I think that the Canadian pensions distinguish themselves significantly relative to other pension systems in terms of maintaining those funding ratios above 100%.
Got it. Steve, you've spent some time looking at the Canadian pension model. Any additional points to make there?
Yes, no, I totally agree with Aaron's comments, and it really is the envy of the world, and we are really world leaders in public pension fund management. You just have to contrast it with some of the horror stories in the US. States like Illinois, cities like Chicago, where Aaron is talking about the typical Canadian fund being well over 100%. You're talking about 60s, in the 60% for Chicago, which is just incredible. These things are not fully funded in the US.
Yeah, got it. So there's a question here. Please address how this topic could affect retirees' investment strategies. I mean, perhaps that's a slightly separate question, but those of us who have Canadian model pension plans, I mean, we should be confident and secure in that our money's being taken care of well. But what should we be doing in terms of either taking the money that comes out or diversifying further? Steve, any thoughts on that?
Sure. Well, first of all, it's important to distinguish the types of funds. And Aaron mentioned defined benefit plans, which are becoming rarer, but they're really nice to have. If you are a retiree in a defined benefit plan, hopefully you don't have to worry. Aaron is working on that, so you don't have to worry. For you personally, Julian, and those of us at Western University, we have a defined contribution plan. So we are the ones calling the shots in terms of where we want our assets to be placed. So there's more care that goes into that. And increasingly, that's becoming more common, certainly for new pension funds. So you need to be more attuned as a defined contribution member. You need to think long-term, and you really have to balance, as Aaron was talking about, this risk and return, because it's one thing to say, okay, I don't want to take on any risk. Well, then you can get a safe treasury bill return, but it's going to be very low. Whereas if you're thinking long-term, decades that you might have earlier in your career, you should be able to take on more risk, such as investing in stock market.
And just a quick follow on the Canadian pension model. I mean, a lot of countries have their huge sovereign wealth funds, which, of course, like Norway has famously, I think it's a couple of $1 trillion worth of sovereign wealth locked away. And of course, you've got Saudi Arabia and Singapore and so forth. Do they manage their assets in a similar way to what we've just been talking about that in the Canadian pension funds? I'm not sure who's going to answer that question. Steve, do you want to?
Yeah, I think Aaron would also be the
perhaps Aaron's the best.
But in general, yes, I think it would be more of the model similar to the Maple 8, where they're very diversified. They're looking at all kinds of different asset classes, mix of public and private. Aaron, would that be your sense as well?
Yeah, and I think to a certain extent, you see some level of internalization of the investment in terms of day-to-day trading and private investments and things like that. Particularly the larger pools, they're certainly very interested in the model. Gives them better control, better transparency, and things like that.
Yeah, I mean, for what it's worth, I mean, coming from the UK, half of Britain's airports are owned by like Ontario Teachers Pension Plan and such like. I mean, it's not obvious to me why UK airports should be owned by, essentially the pensioners of the Ontario teaching profession, but that was the creative, thoughtful investment that they chose to make. And I think your point is well taken, which is you give a bunch of people a long-term view, you give them governance to protect them in their investment decisions. They will come up with interesting and smart ways of investing that money. Good.
One point that I would add here is that often these sovereign wealth funds or large pension funds, the critical ingredient in their success is ability to invest outside of the country of their location. So that they're able to find opportunities to diversify the risk, invest in skill that's needed, etc. So that's counter to what many politicians want to see, which is domestic investment.
Yeah, no, exactly. I mean, this is it. And the moment you kind of prevent people from investing overseas, you've kind of lost the plot, quite honestly, because that almost guarantees a lower rate of return. Actually, one specific question I got earlier looking at the chart. Deglobalization is a term that, of course, is much in vogue. And deglobalization essentially means with greater tariff barriers, greater protectionism, greater national strategies, there's a risk that economic trade not stops, but it goes down. I mean, I understand the basic concept there. How does that then spill over into the markets? Anyone want to respond to that, Steve?
Sure, Julian, I would just go back to, again, my simple model of the two drivers of valuation growth and risk. And I think deglobalization would have a negative impact on both growth and risk, meaning that there would be fewer growth opportunities And with the uncertainty of tariffs, for example, then that would increase the risk. So not a good thing from the perspective of overall global valuation.
Indeed. And of course, globalization has many, many facets. And when tariffs come along, yeah, physical trade is hindered. But, services are not affected by tariffs. And, the movement of people, that's a whole completely separate story. So from my point of view, deglobalization overstates the risks. There's many aspects of the business world which are, in fact, as global as ever. That's my personal view. Question on sectors. Are there particular, and now I'm probably talking about equities, but, Dagmara, you mentioned the famous Magnificent Seven of tech stocks, which is basically 6 tech stocks plus Tesla, for reasons which we can perhaps get back to if you want to. But there's other sectors of the economy which are more affected and less affected. Does any one of you want to offer a point of view on other particular sectors which we should be, particularly keen on right now or should be staying away from? Who wants to go first on that? Aaron, do you want to take that?
Sure. I think, related to AI, even prior to the big surge in AI, a sector that we spent a lot of time thinking about and subsequently doing some investments in was the infrastructure required to power some of this and cloud computing and things like that, because that was a theme that's been going on for a while and growing significantly. So you think about data centers is certainly one. You think about some of the hardware and some of the designs that go in there, but even fundamentally, you start thinking about power. And how are they powering some of these data centers in a way that's sustainable, that doesn't take down the grids of the local areas that they put them in? And so we've looked at a number of different alternatives there. I think areas that will be challenging to invest in or to consider, or you'll have to consider very, very carefully, at least for the near term, because of tariffs, will be some of these things that have a supply chain that is international in scope. Yeah. And you think about the auto parts industry, is our ability to build a car in a single country without having parts cross the border multiple times just is not there anymore. So if we're going to rebuild that will take some time, and there could be some opportunities, but could also be disruptive for the incumbents.
Got it. Other thoughts on sectors to avoid, sectors to invest in? I mean, a classic view, of course, is you invest in defense stocks and you invest in, I don't know, oil stocks or whatever. Dagmara, do you have a thought on that? I mean, I realize that we're now back in the world of equities, but
I think we're in the middle of trying to reconcile different tariff pronouncements from this administration and their impact on the different sectors. The first question is are tariffs negotiating tools or revenue tools? And when you think about for which sectors they appear to be revenue tools, it's for the sectors where this administration wants to protect and grow them internally. This would be pharmaceuticals, auto, and semiconductors. And if these sectors are the ones that are to be built up in North America or in US in particular, then they may initially suffer because of this slower growth, adjustment to higher labor costs, etc. Measures. Whereas in other sectors, perhaps it's only a negotiating tool, in which case tariffs would be temporary and would come off in a short period of time. The other sector, of course, is defense, as you mentioned, which seems to have a boost in Europe in particular. So we're just in the process of trying to distinguish between these different tariff effects on the sectors, but the initial read is what I just outlined.
No, it's a good point. And you've got to actually have a point of view on, what is the purpose of the tariffs? How long do we therefore anticipate that they might be on before you can start taking a view on the prospects for the sector? Steve, thoughts on sectors? And I'm going to throw in an additional question, but let me let you answer that question first.
Sure. I'll give you a very different perspective. I'm in the midst of writing a book, and part of the fun that I'm having is going through old periodicals back to the 1960s. Institutional Investor magazine is one that's well read. And at the beginning of each year, they poll different analysts to try to get them to anticipate over the next year what's going to be the hot sector. And I can tell you, just by reading through these and seeing what happened over the year, that is a really tough thing to do. So for just to keep in mind that as much expertise as we have, to try to time the market or to know not only when to get into that sector, but when to get out of that sector is just going to be a bit of a challenge.
Got it. So the linked question, and I'll actually read the two specific ones we've got here. One is, will the rhetoric and US government action reverse any of the traction in global social impact investing? And then the linked question, how important are ESG considerations, environment, social, and governance for you in the current environment where there's been quite a lot of backlash in the US or even Canada? So, investing, with a bigger set of criteria in mind than purely financial return. Who wants to go on that one first?
I'm happy to chime in there. I think this is something that's critically important to us as an organization, in terms of the way we use this. And I think it's really important because very often there's this thought that, oh, well, to do responsible investing or to use ESG is to diminish your ability to get superior risk-adjusted returns. And I would say you probably could use it that way. But for us, we don't. This supports our ability to manage risk and capture unique returns, and that's how we use it. And in fact, more than ever, I think having the ability to deal with the kinds of data that you see in ESG data sets, which is a little bit gray, a little bit fuzzy. There's not a long history, but you know that there's something material. There's a signal in there, and if you have the capability to really derive that signal, it'll help you do a better job of assessing what are the potential set of outcomes over a longer period of time in a country, in a sector, in a company. So I think more than ever, it's an incredibly powerful tool. I would agree that it has become a part of the political rhetoric, and I think that will perhaps change the way people talk about these things. But in my sense, in the 25 years that I've been in the investing business, this is something where long-term investors, successful long-term investors, have always used something like ESG or responsible investing to make their decisions. They just haven't called it that. So we may go back to a time where we refer to it in a different way, like long-term investing. But I still think it's a powerful tool that can be applied for our members' benefits and for your own portfolio.
Got it. Steve, any thoughts on ESG investing?
I think I really liked Aaron's comments. I would see ESG as simply risk factors that we have to take into account. I would put less emphasis on the E, the S, the G. We should always, as investors, be aware of anything that could be a risk to our potential cash flows.
Got it. Okay, we're nearing the end, and I do want to make sure that the audience gets some, as specific as you want to be, advice. What should investors do? I mean, we've been talking around this topic, but if I can get like 90 seconds from each of you on your top tips for investors. Dagmara, can I go to you first on that? What should investors be doing?
I think for me, it depends what's your starting point. First of all, there is a lot of headline risk, and you should, if you've always had a plan, you continue executing your plan. If you have a shopping list, what you would like to buy, and look at that shopping list, you know what to do when the opportunity like this happens. There is a lot of volatility, and it's not just the overpriced stocks that get thrown out with the bathwater, but also some that had been the casualties of the volatility. If you don't have a plan and you happen to have a lucky undiversified portfolio, now is the time to look at the portfolio and make that plan and look at the risks that are potentially ahead from this trend towards deglobalization, rise in economic growth in Europe, fiscal stimulus there, all the other risks that we talked about today. So I'd say stick with the plan. If you didn't have a plan, make a plan and consider diversification to be the cornerstone of that.
Perfect. I'll go to Steve next and then finish with Aaron. Steve.
Sure. I'd like to echo some of Dagmara's comments. You have to start with an investment plan. You have to start with investment strategy, setting out what your goals are. What do you want to achieve as an investor? How much risk are you prepared to take on? I just, as you know, I wrote a book recently, Trailblazers, Heroes and Crooks. And really why I wrote that book is to use stories to get investors or potential investors to think about coming up with an investment strategy. So that's one point. Diversification is the key. It goes back to Harry Markowitz back in the 1950s. Diversification is the one free lunch that we have. We can increase our expected return for a given level of risk or decrease the risk for a given level of expected return. So take advantage of that. I would also say look at things from the long term. Be a long-term investor. And the final point, Julian, back to a well-known British saying: "Keep calm and carry on." And don't be driven by your emotions.
Perfect. Yeah, not easy to do right now, but definitely smart advice. Aaron.
I think Dagmara and Professor Foerster have really covered a lot of key elements there. In addition to what they say, I think now more than ever, you need to know what you own. So now is not the time to blindly sort of buy into ETFs or to just sort of buy into generic funds and things like that. You really need to understand what it is. And that needs to go down to the level of things like currency, because currency now matters. And as Dagmara described, currency rates can wash out your returns if you're not very careful. And then I think the final point is on resilience. We think a lot about this. Don't predict, prepare. And one of the ways you prepare in investing is you prepare for volatility. It is scary, but it's also an opportunity for the folks that have managed their liquidity and have the diversification to execute on those opportunities when they manifest themselves. And when you see an environment like this, I think we're going to see some opportunities, but you've got to be prepared to capitalize on those.
Got it. Thank you very much. We are going to close there. That concludes then this Ivey Impact live session, Market Mayhem, Investing Amid Chaos. I hope you found today's discussion informative and thought-provoking. It seems success in this environment will depend on a disciplined investment strategy, the ability to adapt to rapid policy changes, to be resilient, and a willingness to explore opportunities, as our three panelists have just said. So whether through diversification or keen risk management, investors need to remain level-headed and informed. So if there's one takeaway from today's conversation, it is that navigating uncertainty isn't just about reacting to chaos, it's about building a strategy that thrives in it. A big thank you to our panelists today, Aaron Bennett, Dagmara Fijalkowski, and Steve Foerster, for sharing their expertise and perspectives. A recording of this session will be shared to everyone who registered, so keep an eye out for that in your inbox. For other thought leadership from Ivey on current business issues, visit ivyimpact.ca. And as you exit the webinar, you'll be presented with a short survey. We'd appreciate if you could please fill it out. Also, be sure to tune in for our next Impact Live event on April the 10th. Necessities of Life, Policy's Role in Food Security, the latest installment in our Future of Agri-Food series from the Centre for Building Sustainable Value. This event will bring together leading experts from across the province to explore solutions to Canada's growing food insecurity crisis and the critical role of policy in shaping a more sustainable future. You won't want to miss this important conversation. And with that, thank you, and I wish you all a great day.